here with the Art of Value. So today is part 2 of summarising and commenting on an interview with Dalio and Jeremy Grantham. So go back to part 1 yesterday if you want to see the first half, but today is probably going to be more than 10 minutes long and certainly more than 2 minutes. So if you're on Twitter, click one of the links to go to the full episode. And if you're on one of the 10-minute versions on LinkedIn and TikTok and where else for this 10-minute short form, Instagram, then go to one of the larger episodes, the longer episodes on YouTube or Spotify or other podcast platforms. Anyway, let's get into it. So part 2. So they were asked the question, both of them, they're both talking together. How are the trends you and Jeremy have been describing likely to play out in the next 5 to 10 years? Ray was asked. So he said, the last 3 years has been a very aggressive monetary expansion. There's a lot of inflation pressure. And notice he said that on a short form video that's just posted on his channel to YouTube in the last few hours. So there's been a lot of inflation pressure and everybody's been long and wants everything to go up. It creates a dynamic where everything goes up. And there's the short-term business cycle of 7 years on average. Sometimes longer, sometimes shorter. He said we seem to be moving a bit faster at the moment. We're going to be in a tight environment, and that changes everything. So returns on equities and well-being of companies is going to affect that, and the rising rates creates a squeeze on equities. It changes the economics, and the cost of debt is changing. So basically it's implying that asset prices should probably be suppressed or go down. There's a shock, a punch in the face, as Jeremy describes, and what he's talking about there is the bubble bursting, a bubble bursting. He's not as explicit as Jeremy when he's talking about bubbles, but he does definitely seem to see it, because that's what Jeremy just described, a bubble bursting, a big one. So he says there's things everyone believes in, that tech companies, like in the tech bubble, and they're getting hammered. So people believe that tech companies were the future, they're going to go up. And he said the negative 75% decline in Cathie Wood's funds, he mentioned that. But he says companies adapt, and corporations adapt when times change, and we're just at the beginning of that. And it's most similar to the 1970s, he thinks. And Jeremy Grantham says something similar to that first the bubble bursting, and then he thinks we're going to an environment similar to the 1970s. So Ray says the 2022 election will have a big impact, he thinks. He talked yesterday about he thinks geopolitics and politics will have a bigger impact than economics, or an impact on economics over the next period of time. He thinks that we'll see a greater political extremism. Moderates are leaving. There are lots of populists, both from the left and the right, and there's a risk that the system is in jeopardy because of extremism and people not accepting losing the election. That's what happened last time, right? And he sees that in a risk in the US and Europe is in that position. So, pretty pessimistic there, you'd have to say. It will be important to diversify well in terms of investing, he thinks, and to be long and short different assets in order that perform well in that environment, like an inflationary environment and a low asset growth environment. So then they turn to Jeremy and ask him, we have a market today that feels superficially like 2000, he says. I think that it's going to play out initially like 2000. The bust that happened in 2000 was quite a long bear market up to that. Unfortunately, I think it's going to phase into the 1970s, and the deflationary effects on the economy and the stock market will result in a world rather like the 1970s, in which all assets will be priced lower than they are today. So they're both kind of on the same page there. So what he says about inflation is that I agree with Ray that monetary policy and general Fed overstimulus for 35 years, the war and COVID, all three influences that guarantee we have a problem in the short and medium term. But he says what worries him is the longer term inflation worries. We are running out of people in China and the US, the developed world, all will be squeezed for labour. So he talks about, he's talking about population decline here, or not replacement rate. We have a scarcity in developing in resources as well. So he's talking about population decline in developing and in China as well, Europe, US, and resources, but also at the same time there's resource scarcity. So we're digging deeper oil wells. The iron ore is not, the quality of iron ore is going down. Didn't know that. So the quality one's the first to go. Said for 100 years, tech got ahead of scarcity. Tech got us ahead of scarcity. We are beginning to run out over the past 20 years. We are fragile now. COVID showed that, and the same applies to food. This price pressure on raw materials, metal, food, and long-term on labour. It feels like a new era in which inflation will be part of the background music, like it was in the 20th century. So there he's talking about scarcity of raw materials continuing, and tech's got ahead of that. Every time we thought there was scarcity, this has been happening for hundreds of years. We're coming to the end, resources have run out, and then we find a way to produce more. But he's saying that, you can agree or disagree with that. I tend to think tech, efficiency, tech sustainability, but he's into that too, as he does explain later. He's one of the biggest areas he's focusing on investing in climate tech. So he said the Fed hasn't got a clue about the debt bubble that's there, and that more debt creating more growth is not proven in the data, which is the assumption at the moment, and there's no evidence for it. It's to do with higher risk from time to time. And Ray reiterates, you might have heard this before, cash is trash. He still thinks cash is trash. The inflation environment, bonds and debt aren't going to be good, he thinks. Claims on financial assets, so you're talking about financial assets not being real, not being like money, it's just a claim on, if you've got an appreciating asset, that's a claim on that, it could go down. So he said prepare yourself, position yourselves for inflation and assets going down, and I put and assets going down. That's my notes, because that seems to be the implication. And I agree with Jeremy on commodities. Okay, so they both think there's pressure on commodities. Companies adapt to a commodity super cycle. You have negative returns in that environment. He's talking about negative returns, not on commodities, but in general assets. Separate alpha from the beta. He thinks how to create a balanced core portfolio in that environment. So he explains you can reduce risk and raise returns by having inflation, by rising inflation investments, investments that will perform well in an inflationary environment. He's talking about that's largely missing from portfolios now, he thinks, and we should be very well diversified. That's what he's recommending. It's not my recommendation, not investment advice. This is just entertainment. So the social and political conflicts will be a big investment thing in coming years, he thinks. We need places with good income statements and balance sheets, places meaning companies and countries, so that they can weather those things. I don't think he might mean weather the storm, but he doesn't come out and say that. And also civil and they are civil with each other. So he's talking about sort of safe places really. Internal conflict and bad finances are going to be defining characteristics of where to invest, or even where to be physically. So he's pretty pessimistic about geopolitical environment. I mean, he even mentioned a war at one point, like a possibility of that. Am I going to take am I going to have a risk of being in an international war? There we go. It would raise lots of threats, different investment threats. He's talking about economic threats. Look to parts of the world that are not plagued with this. He thinks like emerging. He mentions emerging Asia, India. Diversify. Look at neutral countries during that time as well. Watch out for government controls on capital markets, though, and logical step, which is a logical step that happens. History has shown that. So going back to Jeremy, he says, if you believe in inflation, you know that inflation is going to happen and going to stick around. You know resources do very well and the rest of the economy does bad. There's a strong case for a resource portfolio, he thinks. And the last time we had a super bubble in commodities, there were large mines waiting to come online, but they put no capex into that sector recently in the last 10 years. And since China started slowing down its buying and growth in the past 10 years, so it's in a different situation. Raw material constraints he's talking about there. So, and Ray says, the US dollar. He's asked about the US dollar as a reserve currency. What he's talking about, what is a store of wealth in this inflationary environment? He says all currencies will compete. A lot of them, we're in a store of wealth issue. We're in a storehold of wealth issue. So thinking about where, is a store of wealth. What is that in this environment? Think about currencies to hold, storeholds of wealth. Gold. He talks about gold for a while, saying gold is an overlay and only an insurance policy. In war, it's the only asset that's not someone else's liability. So it's like a thing in itself, an actual store of wealth that's not based on debt or credit. It is international and tried and true, can be moved around. It's a hedge. As a hedge, it's good, but not as a core asset. And he talks about 15% of portfolio being in gold, which is quite high, I would have thought. I've pretty much heard him in earlier times talking about 10%, but maybe he's gone up to 15. He said cash will not be the best asset class. Cash is trash. Think of storeholds of wealth, he says, but not cash. Must be able to move it from country to country. Cash is trash. So Jeremy talks about climate change, his investing in climate change. He says, obviously, oil and gas are unsustainable, and he talks about reading history of the rise and fall of civilizations over thousands of years, and there are 5 to 6 major reasons they happen, including overburdening the environment. Complexity is another one. Too much complexity, complexity is very energy intensive, is what we have now. And the current global civilization checks off almost every one of these 5 or 6 things. So pretty pessimistic. He says humans appear to be hardwired to self-destruct. We will expand to fill the space available. But he does say, more optimistically, we've got some escape clauses from this. And one of them is choosing to have fewer children, which we're doing, about population sort of not replacement. We're way down on a replacement rate in places like Europe, Japan, Taiwan, China, and that's a necessary condition for sustainability. So on the one hand, he was saying before, economically it's a stress. It's not great economically in terms of economic growth, but it's good for sustainability. So he's saying also the speed of our science is also a good factor. We're trying to compound on a finite planet, but he says there is a whiff of the infinite that we have in technology, such as fusion and green tech. Fusion of energy that will never run down, abundance of energy, and that is cheap, and geothermal is infinite and green. So these things aren't assured, we don't have enough of them, but there's a possibility of that, and also to energy storage to go along with that, which basically is batteries. And I know he's invested in a battery company. And so store energy storage to go with renewables. If we can get the costs down and mix it with solar and wind, the time it takes to get there will be the problem, though. So if we can get there in time with climate change looming without having too much damage or irreparable damage, So Jeremy has a foundation for climate, and he finds that an exciting area that he's working on and investments in. And we have to look at growth that's sustainable versus not. And he thinks that's kind of been the biggest areas in the coming decades. And I actually agree with that, even if prices are elevated or have been the last few years, it's got to be. It is. I mean, it's got such a huge tailwind. And he talks about EVs versus ICE vehicles, combustion engine vehicles, and fossil fuels versus renewables. So, these ICE vehicles and fossil fuels are kind of sunset, even though we'll probably keep using them just because the whole world runs on it, but progressively changing over transition. I mean, it's got great tailwinds. So that's it for the interview. That's all. So if you found any value on this, like and subscribe wherever, get notifications, and join me on Twitter at The Art of Value. Okay, hope you enjoyed that. See you next time.